Did you know that over 70% of Americans have never invested in the stock market? That's a staggering number when you consider how much wealth the market can create. In fact, the stock market has returned an average of 10% per year over the last century. If you had invested just $1,000 in 1926, it would have grown to over $10 million by now. But here's the kicker: you don't need to be a financial whiz or a stock market expert to get a piece of that pie. Many everyday people have found success simply by sticking to some basic principles. It's all about understanding the game and playing it smart. In this video, we'll bust the myths that surround stock investing. You'll learn why you don't need a high IQ to succeed. We'll share simple strategies that can lead to real wealth, explain the magic of compound interest, and show you how to build a portfolio without breaking a sweat. So, whether you're a complete beginner or just looking to sharpen your skills, get ready to discover how easy it can be to start investing and achieve your financial dreams. Let's dive in. Chapter 1. The myth of the stock market prodigy. Many people believe that only financial wizards or math experts can succeed in the stock market. This is completely false. In fact, Warren Buffett, one of the most successful investors ever, once said, "You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. The truth is, success in stocks isn't about being a genius, it's about sticking to basic principles." A study from Fidelity found that the best performing accounts belonged to people who forgot they had them. Yes, you read that right. They simply invested and let their money grow without checking it constantly. The stock market rewards patience more than brilliance. In reality, people who try to overthink or outsmart the market often end up making emotional decisions, which can be costly. It's been shown that 90% of day traders lose money. On the flip side, long-term investors who follow simple strategies tend to do well. The key takeaway here? You don't need to predict every market move to win. Instead of aiming for perfection, aim for consistency. Even people with no formal training in finance can succeed with basic tools like index funds. It's more important to be disciplined than to be a genius. Chapter 2. Keep it simple, earn more. There's a famous saying in the investment world: simplicity is the ultimate sophistication. When it comes to stocks, complicated strategies aren't necessary to build wealth. In fact, a simple approach often works best. A perfect example is dollar cost averaging, DCA. This strategy involves investing a fixed amount regularly, regardless of the stock price. Research shows that DCA helps reduce the impact of market volatility. By buying both during highs and lows, you naturally lower your average purchase price over time. It's an easy, effective way to build wealth without stressing over market timing. Another no-fuss option is index fund investing. Index funds, like those that track the S&P 500, have consistently outperformed most actively managed funds. For example, data shows that 92% of actively managed funds underperform the S&P 500 over a 15-year period. Instead of trying to beat the market, why not simply match it? And the beauty of keeping it simple is that it frees up your time. You don't need to spend hours analyzing stocks. A few solid choices, invested consistently over time, can outperform complicated strategies that try to time the market. This brings peace of mind, and usually, better results. Chapter 3. Mastering mindset. The secret ingredient in investing success isn't just about the strategies you use, it's also about the mindset you maintain. And the best investors know that controlling your emotions is half the battle. As Benjamin Graham said in The Intelligent Investor, the investor's chief problem, and even his worst enemy, is likely to be himself. Fear and greed drive most market movements, but they can cloud your judgment. For instance, during market dips, many people panic and sell, locking in their losses. Yet, history shows that the market always recovers. After the 2008 financial crisis, the market bounced back, growing by 400% over the next decade. Those who held on, or even invested more, reaped huge rewards. On the flip side, greed can push you to chase hot stocks or trends, like the dot-com bubble in the early 2000s. Investors piled into tech stocks, driving prices to unsustainable levels. When the bubble burst, many lost big. The lesson? Stick to your plan and avoid getting swept up by hype. Long-term success comes from staying calm and disciplined. Even when the market gets rocky, remember that investing is a marathon, not a sprint. Markets fluctuate, but if you stay focused on your long-term goals, you're likely to come out ahead. Patience and emotional control are far more valuable than any complex strategy. So, remember, your mindset might be your greatest asset in investing. If you're finding this information valuable, don't forget to subscribe. We've got more tips coming your way to help you on your investment journey. Chapter 4. Stop chasing unicorn stocks. Consistency is king. One of the biggest mistakes new investors make is chasing after the next big thing. Everyone wants to find the next Amazon or Tesla. But here's the truth. Trying to pick individual, unicorn, stocks is more of a gamble than a smart strategy. In fact, studies show that over 80% of stocks underperform over the long term. The reality is, the majority of the stock market's gains come from just a handful of companies. A study by J.P. Morgan found that between 1980 and 2020, only 10% of stocks were responsible for nearly all the stock market's gains. This means that while it's tempting to swing for the fences, the odds aren't in your favor. A better approach is to focus on consistency. Instead of trying to pick the next superstar stock, stick to investing in solid companies with a track record of steady growth. Warren Buffett, the Oracle of Omaha, famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. It's the long-term consistency that builds wealth." For example, investing in dividend-paying stocks can provide steady returns. Companies like Coca-Cola and Johnson & Johnson have paid dividends for decades, growing them year after year. These returns, when reinvested, can significantly boost your portfolio over time. You don't need to catch lightning in a bottle to succeed in stocks. Slow and steady wins the race, every time. Chapter 5. The power of compound interest. Let your money work for you. One of the greatest secrets of investing success is compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Compound interest is when your money starts earning money on its own. The longer you leave your investments untouched, the more they grow exponentially. Let's look at a real example. If you invest $10,000 in the stock market with an average return of 8% per year, after 20 years, your investment would grow to nearly $50,000. That's without adding another penny. The key here is time. The earlier you start investing, the more powerful compound interest becomes. But don't just take my word for it. A study from Bankrate found that people who begin investing in their 20s have the potential to accumulate over $1 million more in retirement savings than those who start in their 30s. This shows how small amounts, invested consistently over time, can turn into significant wealth. The magic of compounding also rewards patience. The more time your money has to grow, the better. That's why, as investors, our biggest asset isn't just our stock picks, it's time in the market. In the end, it's not about timing the market but time in the market. Chapter 6. Anyone can build a portfolio. Here's how to start today. Starting your investment journey might seem intimidating, but it's simpler than you think. You don't need fancy degrees or advanced financial knowledge to get started. In fact, thanks to technology, building a solid portfolio has never been easier. A good first step is using low-cost online platforms known as robo-advisors. These tools use algorithms to build and manage a diversified portfolio for you based on your risk tolerance and goals. Services like Betterment or Wealthfront make it easy for beginners by handling the hard stuff. If you prefer a more hands-on approach, you can also build a portfolio with just a few core investments. For most people, a combination of stock index funds and bond funds can provide the right mix of growth and stability. For example, many investors choose a 60-40 split, 60% in stocks, 40% in bonds, for a balanced approach. Another popular strategy is the 3-fund portfolio. This simple method includes just 3 types of funds: US stocks, international stocks, and bonds. It's incredibly easy to set up and has been proven to deliver strong returns while reducing risk. Keep in mind that diversification is your friend. By spreading your investments across different sectors, you reduce the risk of one bad bet hurting your entire portfolio. John Bogle, the founder of Vanguard, once said, "Don't look for the needle in the haystack. Just buy the haystack, This quote perfectly sums up why index funds are so powerful. They give you exposure to the whole market, not just a few companies. The most important step is simply getting started. The sooner you invest, the sooner you can start letting your money grow. So, whether you're 20 or 50, there's no better time than today to start building your financial future. If you enjoyed this content, make sure to subscribe. We'll keep sharing more tips and insights to help you navigate the world of investing successfully.